Hi everyone. If you've ever wondered how stocks are valued on the stock market, take a few minutes to walk through this introductory video where we show you 3 different methods that are used to calculate the value of stocks. We use the StockCalc website, www.stockcalc.com, and all of the tools and methods that we show you in this introductory video are available on StockCalc. My name is Brian Donovan. I'm the president of StockCalc. Quick overview, we'll talk about some valuation basics, cost of capital, we'll look at 3 different valuation methods, and then we'll link into the StockCalc website. So let's start with some valuation basics. We're going to talk about a few different terms here. Let's start with enterprise value and equity value. Equity value is the value of the stock. It's the stock on the balance sheet or the value of the stock trading on the stock market. It can be thought of both ways. Enterprise value is the value of the company. It's the value of the equity plus the value of the debt in the company. So why is that important? Well, we can determine both equity or enterprise value when we're trying to determine the value of the company or the value of the shares in the company. Equity is ultimately what we're trying to value or determine because the total equity divided by the number of shares outstanding gives us a value per share. It's also important because there are different discount rates that we would apply to equity or enterprise value. As a note as well, we also look at book value, which is the value that's shown on the balance sheet, and or market value, which is what an asset or the company would sell for on the open market. So continuing on with some valuation basics, a company is composed of equity and debt. Debt is the money that's borrowed from the banks. Equity is the money that's raised in the stock market. And it's important for us to know the discount rates or the rates or costs of these different components. So the cost of common equity, think the return that you would expect on a stock that you invest in. Preferred equity, think of it as the dividend rate in percentage. Debt, interest paid divided by the debt outstanding. These are all important because generally we calculate something called a weighted average cost of capital for a company, where we take the percentage of the company that's equity multiplied by the cost of equity, plus the percentage of the company that's preferred equity times the cost of preferred equity, plus the percentage of the company that's interest-bearing debt times the cost of the debt, and we reduce that by the taxable rate because it's an after-tax cost. If we want to calculate enterprise value, we use WACC, which includes, as you see here, equity and debt. If we want to calculate the equity value directly, we simply use the cost of equity, or KE. So those were the basics that we wanted to talk about. Let's talk about the approaches that we can use. A cash flow based approach, we take cash flows and project them into the future, discount them back at the cost of capital, and then there's a few calculations that we'll show you in a minute to allow us to come up with value per share. An asset-based valuation allows us to take the market value of the assets and subtract the market value of the liabilities to come up with what we think the value of the company is. Finally, a comparable or relative valuation allows us to value a company based on comparable companies. So we'll get into these. So if we want to do a cash flow based valuation, there are a number of components that we need. We need to project the cash flows. We need something called a terminal time or terminal value, a discount rate, our weighted average cost of capital, for example, the debt that's outstanding in the company, and the number of shares that are outstanding. We put this all together into a calculation that looks like this. Cash flow in each of the years going forward to a point where we think the cash flow is in a steady state. The cash flow could be flat from this point on. It could be raising at 2, 3, 4% per year. It could be falling at 2 or 3 or 4% per year. But we know that it's a steady state. It's not going up or down dramatically at that point. The discount rate, or the cost of capital that we talked about. So with the discount rate, we can calculate something called the present value factor. 10% 1 year from now is worth 0.91. 10% 4 years from now is worth 0.68. So we can apply these present value factors against the cash flows to come up with the present value of these cash flows. So 70 million 1 year from now is worth 64 million today. 100 million 4 years from now is worth 68 million today at a 10% discount rate. This is all done for you automatically within StockCalc as well. With the terminal represents, from this case, year 2020 and beyond. So we need a factor to account for the fact that this is more than just 1 year. So we have a formula here where we take the cost of capital and subtract what we expect the growth rate to be. 100 divided by that gives us a multiple that we can apply to that cash flow to give us the total value of the cash flow beyond the final year, so the terminal cash flow. If we add the cash flows from the first 4 years in this case plus the terminal, we get the enterprise value of the company. So the total value of the company, debt plus equity. If we take that enterprise value and subtract the debt, we're left with the equity value. So the equity value contains both preferred and common. If there is preferred equity, we would subtract that to leave us with the common equity. Common equity divided by the number of shares outstanding gives us the value per share. This is a very common analysis that's done on stocks. And as you see, there are really two important lines here. What are the cash flows in the company? And what is the cost of capital or discount rate that we're using? Both of these are available within the StockCalc site. On an asset-based valuation, there's two that we look at. An adjusted book value, where we update the assets and liabilities on the balance sheet to reflect the market conditions. Or a liquidation value, where we do that same adjustment and we determine the gains and losses during a liquidation or a bankruptcy. So as an example, if we have this summarized balance sheet available, assets, liabilities, and equity, the assets equal the liabilities plus the equity. So in this case, the equity is 1 million or 100 million. Number of shares outstanding is the same. So if we divide these two, we would get $1 per share. If we took the book values and adjusted them to what we think the market values are, and that we took the assets and subtracted the liabilities, we would have the equity available, divide that by the number of shares outstanding, and we would get a market value for the company on a per share basis. On a liquidation basis, we would take the market value of the assets, and there's some costs that we would take into consideration here. Disposition costs, profit or loss during a liquidation, any specific cost during that liquidation, taxes that have to be paid if there's profit that's still remaining, the liabilities that are in the company. So as you can see, we would subtract these down until we get the equity remaining in the company. If there's preferred shares, we would remove those and then divide by the number of shares outstanding to give us a liquidation value per share. Again, both of these are available within StockCalc. Finally, on a comparable basis, what we're doing is we're valuing one company against its peer group. We're looking for companies in the same industry, similar company size, geography, target markets, technology, etc. And we use metrics like price to earnings, price to cash flow, price to book, or price to sales, EV to EBITDA as the metrics to compare. So for example, if I'm looking at Intel, and I want to value Intel on the basis of 3 other comparable companies, what I will do, and what the software does for you, is it will pull forward the price to earnings, price to book, price to sales, price to cash flow, and EV to EBITDA ratios for the comparable companies, average those, and multiply those averages by the existing or current earnings per share, book value per share, sales, cash flow, and EBITDA per share, for example, to give you an actual price based on the comparables. So you look at these and you see that there's a range of 35 to approximately 55, and you say, well, what's right here? Well, companies that are very asset intensive, you would tend to use a price to book ratio. Companies that are more cash flow dependent you would use more of a price to earnings or price to cash flow ratios. So on the basis of a company like Intel with very little debt, very high cash flows, we would probably look at the earnings per share and the cash flow per share. We see 41.63 and 43.75 as relative valuation numbers. You could average all of these and still come up with probably in the $45 range. But based on this, if we look at those two ratios, we would say that the company is probably fairly valued around the $42 or $43 range, using these as our comparative companies. So that was a quick introduction to how stocks are calculated, how the valuations are calculated. We went through some valuation basics, talked about cost of capital, and looked at 3 different valuation methods. We will be doing some additional sessions as well. Here you see the welcome page for the StockCalc website, www.stockcalc.com. And if you try StockCalc now, it will actually bring up a 14-day free trial that you can subscribe to. So I hope you found this informative as an introduction to how stocks are actually calculated, how their valuations are done on the stock market. And we hope you find the StockCalc website useful. Thanks for your time.